Hey guys, we have a special guest coming in this video. His name is Valentino. He is the president and founder of Core Health Ventures, and he specializes in healthcare acquisitions. And he is going to share with us how he structures his acquisitions. Thank you so much, Valentino, for your time here with us. We're
Thank you
looking
very
forward
much.
to it.
Thank you very much, CJ. So let's get started, guys. As you can see on the screen, I have this PowerPoint presentation laying out step by step an overview of how we go with our acquisitions. So as you can see on page number 1, M&A financial structuring, how to make the numbers work. So let's start with the financial parameters of an acquisition, what to look for, the initial check. Then we go with leveraging commercial debt, bank lending parameters, and the LTV. Then we move on to the seller financing, how to structure the seller financing portion. Closing on your offer, the negotiations. This is the most important part of them all. How to come to a win-win where the seller gets more than asking and you retain working capital and are able to share and service both debts. So
Nice.
the foundation of negotiation is either your price, our terms, or our price, your terms. Now, what is the business worth? That's key. The business is worth what the market dictates, not what the owner wants. And you got to understand, private businesses are valued at a multiple of the earnings as there's no liquidity. And liquidity means stocks. Public companies can liquidate their stocks, so you buy it at a stock value. There's different valuations, but we're focusing on private companies. Now, financial parameters, what to look for. Now, we do a preliminary assessment on our acquisition targets. We want to make sure these are clean acquisitions that will go to our portfolio. Number one is the net profit. We look for net profit margins of 20% plus. Why? There's room for error. You got to understand, when you get involved with businesses that are 5-10% profit margins and the market drops 20% or the business loses 20% of its clients, it can affect a lot of the operation. So 20% gives you that cushion. Now, no major red flags: fraud, lawsuits, liens, bankruptcies, expired licenses, cookbooks, liabilities, or future and potential liabilities. We look out for that. And the third thing, which is steady growth for the past years, no major fluctuation regarding the revenue to earnings ratio. Now, as you know, COVID affected the marketplace. It affected almost every business. Some possibly, others negatively. But we want to see, what banks are interested right now is how was the business able to bounce back from COVID financially. So let's get started with leveraging commercial debt, your loan to value, and how to structure the financing. Now, these are the average lending parameters. We got a SBA, which the year length is about 10 years, so no real estate, 4.5% average interest rate on the loan, and they're looking for a DSCR of 1.25. Now we got non-SBA, which are branch-based lending. We get about 5 years, no real estate, 5% interest rate, and DSCR vary either between 1.25 to 1.5. Now, loan to value basically is how much are you giving down on the business? Is it 80% down, 70% down, 60% down? You want to give above 51% to have that majority ownership in the business. Now, let's take a look at the financial structuring. We got commercial and we got seller finance. Now, we could go up to 80% LTV, and these are cash flow based loans. When you're calling these banks, you're telling them we're looking for cash flow based loans. Now, they need to be some sort of collateral. They could take accounts receivable depending on how old the accounts receivable are. Usually after 90 days, they discount them heavily. And from who? If it's a Fortune 500 or government, they pay, but they pay slowly. If it's from somebody who's not Fortune 500 government, chances are very slim. Equipment as well, but equipment is discounted at a resale or liquidation value. Now, you got to understand, when we put the down payment commercially, the seller's taking 40% on taxes. That is capital gain taxes. Then we got the seller finance portion. Now, depending on the motivation of the seller, we either got a 20% minimum to a 40% max. We're looking at 10-year financing, and we structure it this way: year 1 to 2, no payment. Year 3, interest only, 5% on the principal, which is not discounted. That's like an added bonus. Year 4 to 10, principal plus interest. Now that is his earnout slash retirement, and that's what we use to bring up the incentive of using seller financing. Now the great thing of seller financing is because he's collecting interest on his money. First thing is less taxes as he's taking less money up front, and the second thing is he could live off the interest on the principal, as is usually a 40%. 20 to 40%, which is a pretty big portion, and that makes up for it. So we are able to offer a minimum of $1 million over asking as an incentive to seller finance due to the interest collected, which is great. Because as you know, majority private equity firms or other firms involved in the M&A, they buy the business at a discount. Why? Because they're able to give more upfront. We're looking to structure in a way that we're able to get the seller what he wants, and not only that, we're able to retain some money as working capital. So another thing to look at is the legal entity structuring. We got the main co, and then we got our subsidiaries. Let me give you an example. Let's say Core Health Ventures is the main corporation, and we got a dentist subsidiary, and we got a home health subsidiary. So home health businesses going subsidiary number 2, dentist subsidiaries, acquisitions going subsidiary number 1. Reason is we structure everything in its own LLC for legal protections. Now we got the seller financing portion. Now before we get involved, CJ, you got any questions regarding the commercial financing?
You know what? It's been so comprehensive. No, I don't have any questions on that.
Great. We'll dive a little deeper in these coming slides. Now let's take a look at the seller financing. How do we create a motivation for the owner to seller finance over 10 years? That's a long period of time. Now, primarily it depends on who the seller is. If he's a senior person, which is our main person of interest, we got the baby boomers. I'd say there's about 90 million who are currently baby boomers that are actively looking to retire, which is a great market. So if he's looking to retire, the incentive will be that the more money he takes up front, the more he will be taxed, about 40%. So allowing him to take just the necessary up front and seller financing the rest over 10 years with interest collected on the money will allow him to create a retirement plan where he can live off the interest. Now, I got an example of a call. If that's cool, CJ, we could run through it. It's about 3 minutes.
Yeah, absolutely. Yeah, let's run through the call. I actually heard that this is going to be a $10 trillion tsunami coming up because there's going to be more baby boomers that are going to be retiring. About
Absolutely.
11,000 a day.
Wow, 11,000 a day. So, guys, you got to understand, COVID changed the game. COVID changed the marketplace. Now we had what the government giving incentives in the beginning with SBA lending money to businesses in order to keep operations going. But how long was that? That was a couple months ago. You know, SBA gives up to $5 million, so that's been drying up. Maybe they run out of working capital. So we're actually doing them a favor. I actually read an article that only 10 to 20% of people who are looking to exit their business actually exit. So if you look
Mm.
at it, we're actually offering these guys opportunities. So let's run through his call. So is there an interest in you selling this business? So let me give you a quick overview. The seller, she's a woman. She's looking to retire. She just adopted 2 kids, adopted one in the process of adopting the other one. She's looking for an early retirement, where she's looking to spend more time with her kids. So she wants about $3 million for his business. We were speaking to a main guy, the guy that runs the business, and he told us that she wanted about 300,000 down and the rest over 7 years, which was great. But now she came back saying that she wanted 3 million up front. So look how we're able to take her from first saying in this audio she's not interested in selling to looking at 3 million up front to actually taking a look at financial structures that will benefit her.
Am I interested in selling it?
Yeah.
At this point, no, unless, like I told Cole, I've made some massive investments in the past month and a half
Yeah.
to press forward, and I kind of shifted my mindset that I was no longer interested in selling just because it was a pretty laborious process in getting everything together for the sale of it initially when we started back in April.
Mm-hmm.
And I can't I can't take a down payment with 1.8 owed still with absolutely no interest. I mean, that's not how the world works. Um, in just hopes that it's going to continue to run in the way that I've been running it and be able to actually get my money back at the end of all that. Really, the only way
Hmm.
that I would press forward is at the 3.15 in one sum.
So you're looking for $3.15 million in one sum.
Right. Yep.
Okay. You understand when
Can you also go ahead,
you understand that when somebody comes and purchases a business and full asking price, they usually buy it at a big discount. Not only that, if I were to pay you $3.15 million cash, you're taking 40% in taxes, right?
Yep. I know.
Are you okay with that?
Sorry, are any of us okay with that? No. But it's just the way the world works.
Instead,
So
if this is something that may interest you, we could structure something instead of 8-year payout, something around 5-year payout. So we're helping you with the taxes as well. Would that be of your interest?
I mean, the thing is I don't know what collateral there is on the line, and I am not going to loan $1.8 million at 0% interest. That's just not. I mean, that's not possible.
No, absolutely. Actually, we're here, to get more of understanding. If we were to do the 1.8 loaned out, what interest rate would you be interested in?
I would have to give that a little bit of thought.
Right now,
so come,
uh,
go ahead.
if we're looking at market interest rates, we call for you between 3 to 5%
Hmm.
on those numbers. You know, when it comes to
And
So
speak.
go ahead.
for the note, then is that still going to be? Would that be through Angie and Cole, or is that to you guys?
The note we're gonna. Okay, so let's run over this. First of all, she wanted the $3 million. First, she didn't. First, she said she didn't want to sell. Getting the paperwork done, getting everything set up. Then it looked like she sparked an interest. Hey, if I were to sell, I want the 3.1 million up front. Now, the other thing, two major concerns was with this seller. How do you guarantee I'm gonna get paid my portion over that amount of time? And the other thing is, how do I know the operations are gonna continue for the business? You get what I mean, CJ? So those are two very legitimate reasons for the business owner. It's 10 years, so we got to look at making the seller understand the bigger picture, that the reason we're structuring it this way is for us to be able to free up working capital, that with that working capital we're able to use it to grow and expand both on supplementary and complementary acquisitions to maintain a dominant position in the marketplace. Not only that, you got to sell her your team, their experience, so she gets at ease regarding that. So how do you pitch it? Seller says, I want $5 million up front. So CJ, let me just throw a pitch, okay? So, let's say CJ wants $5 million up front. I tell him, well, CJ, if I were to pay you $5 million up front in full, all cash, I would pay you half. That's how it works. But let's say I were to pay you the full $5 million, then 40% will go to capital gain taxes. That's about $2 million. Let me ask you, CJ, how many years have you been involved in this company?
And we'll say about 5.
5 years. Okay, so you're looking to use this money for your retirement, right?
That's right.
Okay, so you think it's fair that you dedicated 5 whole years to your company and the economy, and then when you try to cash out on all your years of hard work, they take 40%. Is that fair, CJ?
No.
Well, we want to get you as much money as you can for your business, but also free up some working capital in order to retain a dominant position in the marketplace and grow and expand the business. We can help you structure something that is not only beneficial to you, but to a company as well. Is that something that might interest you, CJ?
Man, it definitely interests me.
Done. I'll forward you an offer on Excel and we can take a look at it. So, part 4 is closing on your offer. how to negotiate your offer and come to an agreement. Once you guys have, a price in mind, how do we close on it? Put it on paper. Now, we're taught to doubt what we hear and believe what we see. Is that correct, CJ?
That's true.
So if you start throwing numbers that sound too good, he might not believe you, and he might want most of his money up front. So what I learned is you make him one offer on paper and a spreadsheet, how much he's getting up front and how the seller finance is structured. So he can then see where you got those numbers and pitch the reason for it. Not only is it to help him with taxes and gain more over time, but it's also to free working capital for the business so he doesn't have to put out of his pocket. And after he agrees to lock in the LOI on those terms, we can begin the final stages of due diligence and move forward with a PSA. So that is it. Any last questions regarding that, CJ?
No, not at all, man. I like the fact that you remind the people that it's going to be 40% out in taxes.
Absolutely.
40%, man. So that's very good.
Absolutely. You gotta understand, guys. These people, they're in their 60s plus. They're looking to retire. Not only that, they're looking to give money and leave money for their kids, for their family. And if they've been working 10, 20, 30 years in their business and they're gonna lose 40% of that like nothing, they're not going to be very happy with that. But remember, you're not selling, and there's the thing regarding sales, we're not selling in a pushy style, take it or leave it. It's more we're selling as a consultant. We're their consultant. We're advising them on what could happen, what could not happen, and we're offering the best option. You got to understand, we position ourselves differently because we're not private equity. We're able to move quickly on the deal. We're able to offer the best terms. Private equity takes about 90 days to come to an NDA. Think about that. In 90 days, you could get that deal closed. So that's what differentiates you, the speed, getting him his money as soon as possible, that he knows he has his business as well in the right hands. Now, another thing I want to talk about regarding the structuring of the company when it comes to financing with banks, the second most important thing after the numbers work is continuum of management. They want to know the people are still going to be involved with the business, and the best way for banks to lend is to keep the owner on board for a 6 to 12 month transitory period. Remember, you're coming into these businesses and you cannot come in disrupt environments. They already got a way of doing things 10, 20 years. They got a way of handling things. So you want to keep the owner on board so they know he's still there after the sale. And they're not going to be scared that you're going to come in, fire everybody like is usually done in a M&A situation. But you're actually there to provide them better training, better options, better tools, and not only that, the insight and advice from your board of experts who've been there and done that to build that company to a next level. What do you think, CJ?
No, I think that's very wise, man. Keeping that owner there is not something that you would think of at first, because let's say you're new, you're beginning at it, but that's very wise because now you're coming in, right? You've
Yeah.
made the deal, but the owner's still there, and so the waters are still calm, and that's what you want.
Absolutely. Give peace of mind for everybody involved in the transaction. Now, guys, this was just an overview. We're going to actually drop an in-depth video with an Excel spreadsheet, how to structure a business, and we're going to use one of the current deals we have on the table, and we're going to take a look at it, how to structure a commercial debt portion, how to structure a seller finance portion, how much the owner's asking for, and how much he's actually going to get on our structure. We're also going to post the negotiations for that and everything regarding the process of that acquisition. So stay tuned. It's a billionaire acquisition mastermind. Can you post that link in the description, CJ?
Absolutely, I will definitely post it in the description.
Great. Thank you very much, guys. Thank you, CJ, for this opportunity. Take care, everybody.
Hey, thanks a lot, Valentino. My goodness, man, that's already been a billions worth of information
That's the purpose.
that we have,
Billionaire
man. Yeah.
Acquisition Mastermind provide real insights from people who are currently in the trenches, like myself and my associates, who are doing it on a daily basis, and the people we speak and network with, who are people who've done billions in transactions. And we're talking about transactional attorneys, M&A advisors, people who are roll-up experts, true negotiators. We're here to give out true information, and we believe everybody should be able to have access to that information. Makes no sense. Makes no sense paying $10,000 to $20,000 on a course where they do not provide real insights. We provide the true insights. So thank you very much again, CJ. Catch you guys on the channel. Take care.
Absolutely, man. Thanks a lot. We'll definitely talk soon.
Absolutely. Take care, guys.